where do we go from here? Because this has been a choppy year, but is the worst over in terms of the risk priced into the markets, given all that we're seeing, geopolitical risk, risks tied to the fiscal situation of the U.S.?
This is the environment where one
needs to buy insurance.
Justify a tail hedge because of the uncertainty rather than a direction. But and of course it did work out this time, as it does work out, almost always. But it did work out, compared to other approaches to hedging that either failed or didn't perform well.
You became a household name, essentially, at least in Bloomberg viewing households, when you wrote The Black Swan. And I wonder if now that we're all thinking about that after you sort of unveiled it, if it's less of a threat, because we're all looking for the unknowns.
No, actually, what has happened is it's more complex. It started with fooled by randomness, where people don't understand the difference between noise and signal, and mistake very often noise for signal. Things have gotten worse. Okay. The understanding of tail events has gotten worse. Okay, the pricing of tail events, one would think would be more rational, has gotten worse. Okay, people use bad models more and more.
Wow.
And so it is interesting. I saw that over a 25-year, the life of my book collection, The Inserto, the first one being Fooled by Randomness. So I don't think that there is consciousness of risk that has improved. We just think that at any point in time that we live in a more risky period than our ancestors or that we did before, but it's just a normal perception.
So it's interesting. A couple of years ago, Mark Spitznagel over at Universa warned that this was a tinderbox time bomb of a situation with the U.S. debt load, and that certainly has gotten worse. But the markets have been pretty complacent to it. So is this time different?
Yeah, let's look at markets. Okay, markets are not driven by long-term economic stuff. Is driven by allocations. Okay, for example, people think that the market reflects today the impact of the tariffs and these policies that may or may not be rational. No, markets are driven by certain allocation parameters, and people, of course, panic sometimes, but they got to satisfy these. In the long run, of course, the economy will decide, and we have severe problems. The first one being the accumulated deficit. It is snowballing, as you know, and with interest rates here, it is adding every year to the budget, so just to stay in the same place. Plus, what has happened with a lot of modern economies is that as you get richer, you see, it's normal that your growth rate would slow down because you have fewer people in poverty in your economy. You have to import, actually, poverty from elsewhere. Okay? It's like an S-curve, like a natural S-curve that we see in nature. At the top of the S-curve is when people borrow, when their growth potential is much lower, and for natural reasons. It's nothing to do with policies. So we should be borrowing less now that we have reached almost reached destination, because it's what we call a decreasing growth rate, and which is normal, whereas countries in Africa and Asia are far away from that point. You see, they still have people in poverty that they got to pull up, and that will increase their GDP. And they can borrow, but they're not the ones borrowing.
Right. But we're not going to be borrowing less. I mean, clearly, we're going to continue to increase deficits, at least if this one big, beautiful bill is passed. And I wonder about the products that Universa sells, right? You can hedge against the kind of tail risk, like if the U.S. defaults on treasuries, right? We see a drop.
We are focused on the stock market. We just use that as a driver. Okay?
Right.
So because you're targeting one variable. You're not targeting events because events are not well defined. But that variable is very well defined.
Well, I'm just saying that this is an event, a default that would trigger, an instantaneous drop. But it's harder to hedge against something like the slowing decline of the dollar.
Yeah, but okay, so that is but that would end up being reflected in stocks. the slow decline of the dollar. And effectively, the second risk, so the first one is the deficit. The second one is effectively that the dollar is losing its status as a reserve currency.
What proof do you have of that, though?
You can see the accumulation of gold in the reserves and the behavior of gold over the past 12 months, and it didn't start with Trump's policies. Of course, it started with Biden when he froze the accounts of people connected to Putin.
Right.
And of course, thinking that it'd be limited there, but people not connected to Putin, okay, decided to stay away from a euro and a dollar, and gold is effectively now the reserve currency.
So
transactions take place in dollars, euros, usually dollars, and at the same rate. However, they get converted back into gold, and we can see it from the accumulation of reserves.
You know, it's interesting. Citigroup just this morning said the gold rally might hit a timeout this year. They said that it could start to retreat after running to near record highs.
What do they know? How do they know? How do they know?
Well, that's my question to you. If you were afraid of where the U.S. deficit is, if you were concerned about the dollar, and at this point geopolitical risk, are you stockpiling gold? Even at this level?
Okay, I'm not a central bank, so, I mean, I think that with what's going on now, particularly with the new administration, the perception of America is the riskiness of America has increased. So on top of that move into gold that started with Biden, we have now a move into gold by people who are afraid of these policies, and
including central banks around the world, which doesn't look like it's going to let up.
Especially central banks around the world. So the dollar is a good transactional currency, because people can label things in it, but not necessarily a storage currency. And this is what we're facing now.
Just over the last 24 hours, we're hearing that Millennium, for example, is one of the firms that is looking to sell a stake at a $14 billion valuation. These massive multi-strats and non-banks have been much bigger in the market. Do you ever worry about systemic risk with the way things are going?
Much less with hedge funds, and I kept advocating for the transfer of risk from banks to hedge funds, because hedge funds don't have the skin in the game problem. Okay, bankers, of course, they they have very little to lose, and they're prone to bailouts. On top of that, hedge funders have their money in it, so I think the risk management is much more rational with hedge fund than it has been with banks. Banks, they use just models to cover their reputation and nothing else.
What do you think, though, about the opacity of private markets, especially as they continue to grow? I mean, they're bulging, right? Everybody's racing to put money into private credit, and it has been for years, and yet it doesn't. There's no Carson Block looking at these.
Okay, if there's no bailout potential, then opacity isn't harmful. You see, because those punished will be those who put money in it. That's the functioning of a normal functioning of a market. However, if there's a potential bailout, then we need to know what we may have to bail out. You see, so this is where I would look more into the details of what we are insuring as taxpayers, what we are insuring.
But so, Nassim, that's better off bank, right? That's better in the shadow banking system. If it comes to, a bank branch near you, then it's a problem.
But the banks are lending more to the non-banks. That's the problem.
Banks became utilities progressively. After 2009, 2008, 2009, after that period, people understood that they should not be taking risks, and progressively, money went where it should go.
You know, it's interesting. The hedge fund industry, by and large, throughout the course of this year, we've been talking about it a lot, they've done okay. Actually, everybody has held up through the course of all of this volatility. My question to you, you were talking about the big risks that the U.S. is posing.
Yeah.
What about the Trump administration's strategy? Is there more volatility ahead?
So, let me tell you, long term, this is why I think that we need to worry, maybe not about the stock market, it may express itself elsewhere. We need to worry because the approach is not very rational. First of all, they're amateurs doing numbers to start with. The other thing is when we have 4% unemployment, think about it, you have 4% unemployment. It means the economy, what are you going to do now with these tariffs? Try to shift business from high added value into low added value? This is what we're invited to do? Well, that will depress GDP. So in other words, it's like asking a surgeon, just for balance, to clean the streets one day a week, okay? So of course, it would depress GDP. That's exactly what the Trump administration is getting us to do. I understand tariffs. Tariffs may be necessary in many areas. Tariffs need to be symmetric and stuff like that. So this we understand. But the way they're going about it makes no sense.
Can you understand, the reasoning behind it? Because these are people, that Trump has around him. Scott Bessent, Howard Lutnick, Stephen Miller, who, they're not idiots, right? They've done well in their careers. They went to Ivy League schools. Like, why are they doing this?
There's a difference between, they're not idiot and they're not specialists in that area.
Right.
And they're probably okay in what they've done in the past, although
Peter
I'm not
Navarro.
sure about all of them.
Yeah.
Peter Navarro, I apologize, but I'll have to say that in his own domain, he hasn't fared well. Okay, the other ones had some kind of performance in an area that is orthogonal, in other words, uncorrelated to the current performance. It's like asking a dentist to do brain surgery. Okay, may do better than average. I'm not sure. Okay, so none of them really is a specialist of the area that they're discussing. And this is where I find myself agreeing with the economists. Okay, that basically it makes no sense, and the approach is irrational. You see, the idea of confronting China is irrational. But now let's think about what are going to be the effect. Well, there are two things they're doing. The first one, tariffs on things that we don't produce. It's going to tax not the middle class, but is going to class
the poorest among us.
The poor, because
it's regressive.
and then compensating that with a tax break doesn't work if you don't pay taxes.
Well, my question too is, you have the Treasury Secretary saying that, okay, well, maybe artificial intelligence will make this economy more productive. Do you buy that?
Maybe we can wait.
More jobs.
Yeah, maybe for Christmas we'll get Santa Claus coming in and distributing money. A lot of things can happen with maybe. You see, as the French would say, with maybe you can put Paris in a bottle. All right. So the idea of these the tariffs may be sound. The way they're going about it is it's like trying to wreck the boat voluntarily. That's the first one, is tariffs. The second one is immigration. I don't know if you realize the structure of American businesses and American labor. Last time we had a labor shortage, we saw what prices did, okay? People have large loans. Everything is based on cheap labor, okay, coming from Latin America or elsewhere. Everything's based on it. So trying to constrain that source of labor may make sense in the long run, but like in Japan, for example, they have small houses. Here, people have mansions. Okay, you won't be able to find people to mow the lawn or do things. And if you have to wait for artificial intelligence, okay, let me know when it comes and revise my opinion. For the time being, we don't have cheap robots.
Yep.
So there's a lot of dangers in these policies, because it's not that they didn't think of the second order effects.